Hello, folks. Mike Newmeyer again, and I hope you like my jacket. I'm getting ready for summer. Yeah, spring is about to spring. Okay. And I'm a financial advisor. We meet every week. Remember me? And I've got a lot of information for you this week, and I hope this information is helping you. And I hope you'll call me at 410-902-0464 to discuss this or anything else you want to discuss. And of course, I'm in business, and I provide really safe money products to people who want to retire. I got a call from somebody yesterday, and they were talking about a variable annuity. And I said, please, please do not buy a variable annuity. I stopped selling those 20, 25 years ago because the problem with those things is they're in the market, number one. They can't always fulfill their promises of lifetime income. They may give you some income for a lifetime, but it may not be anything you're really interested in. And of course, they go up and down with the market, and that's not a really good thing for people that are retiring. I could tell you a lot more about them, but but enough to say, if you want to talk about one, we can do that. But I don't recommend them for retirement income. Okay, so today I'm going to talk about some roadblocks to retirement, and I made a lot of notes here. Let's see how much I can cover. Okay, and then let me just get started. Okay, remember Mike Newmeyer, Newmeyer Consulting, and that's Game Plan for Retirement. And you can look at our website, Game Plan for Retirement, and learn more about us. We have a whole lot of podcasts that are on that website that you can access on different topics, and that's a good idea. And if you want to talk about any of that information, I'm more than happy to talk to you on the telephone. You can come in and visit me. I always love to see people, love to meet people, and you don't have to buy anything if you're not interested. But you can certainly call me or come in and we'll talk about what you want to talk about. And I don't charge for my time. I've never charged for my time. I know if people in the business say, why don't you charge for your time? But I just don't. If I did, there's a lot of folks that wouldn't call me or wouldn't come in because they don't feel like they can afford that. So anyway, now let's get on to the topic. And these are some things that you got to consider, and they can be roadblocks to retirement, okay? All right. So number one is people don't define always what retirement means to them, meaning how they're going to spend their time, what do they hope to accomplish, and what their family wants to do, and what their spouse wants to do, and what their resources are, and all that sort of thing, when they're getting ready or they're starting to think about retirement. Typically people will sort of daydream about that sort of thing if they're looking forward to retirement. People that are looking forward to retirement, you could define them in two categories. Those are the people, one, they're trying to get away from work. That's their reason, because they just want to get away, or their family wants them to get away from what they're doing and spend more time with them. So that's one. And the second one is the people that are looking forward to doing things. They want to leave because they want to, whatever it is, they want to go fishing, they want to go camping, they want to travel the world, whatever it is, they're just looking forward to doing those things. It isn't so much getting away from. In fact, there's lots of folks that get away from but still go back and work part-time or do some sort of work. So it's sort of a blend in some cases, but are you going away from something or are you going towards something? Okay. So that's one thing. And then they've never set financial goals in terms of what they need in order to retire. And we'll talk more about that. And they don't educate themselves about personal finance. You got to understand some personal finance. When I talk about budgeting to people, that's a word no one wants to hear, budgeting. This is almost as bad as saying taxes. Nobody wants to hear about those things, but death and taxes, got to count on them. Anyway, so maybe we'll get some relief on Social Security taxes because the current administration wants to do that. So let's hope. And then they don't take a financial inventory. If I say to people, what are your assets and what are your liabilities? Can you write those down? Can you give me a list of the things that are assets and what their value is today? Some folks have to do a little research, which is fine. in order to answer those questions. Sometimes they've got assets they've completely forgotten about. If you're working with us on a continuing basis, we'll give you a book to keep track of everything that are assets, everything that's liability, everything that's insurance, various kinds of things, everything that's income, and no matter what it is. So we help our people, maintain an understanding of those things, and also provide that information in a manner that can be understood by the family in case they need to know and need to act in your place. Okay, so those are some things. And then managing credit wisely with the prices we're paying for credit these days, with the interest we're paying. I had somebody here just a little while ago says they always pay off their credit cards monthly. They don't ever leave, and that's a big deal. With the interest, I know people that are just barely making the interest payments every month. So, that managing it wisely is, what are they doing with the credit? What are they doing with the credit? If you can get 2% back on everything you buy, for instance, then that's a good use of credit. As long as you pay it off, then it's not really costing you anything to get that 2%. So not all merchants like that too well, do they? Because they're paying 3% in a lot of cases. And they'll tell some folks, here's the price if you pay credit, here's the price if you pay cash. Because they understand credit very well. And that cost to them has been creeping up for a long time. And today they're very conscious of it. That's very close to what they're earning in many cases, because they've had to absorb a certain amount of inflation that they couldn't pass along and still maintain their sales. So those are issues to understand. And then let's see, they don't invest early. Well, some of us, that's too late to invest early, but that is the case. And teaching our kids the what's so important about investing early and saving money early. My dad used to say, it's not how much you make, it's how much you save. And I think he was pretty right about all that. So, investing and saving money, very important to pass along to the next generation. And don't use tax laws to your advantage. And they're talking here about, we're talking here about tax advantage kinds of things, the annuities we use, the safe money products that we use. They grow tax deferred. Anything you can get to do tax deference with, all IRAs, of course, are tax deferred. And so, that's a good thing. And we put a lot of product, we do a lot of rollovers, 401ks and IRAs and TSPs and so forth. And those are tax advantaged accounts. So what we want to do there is to keep the IRA status. When we roll it over, it's an IRA. So that stays, sacrosanct until you actually use the money. And that continues until you're 73. And then at that point, you've got to take required minimum distributions. Some people will ask me, what's a retired distribution? And what that is the government, the IRS, they want to tax you on some of that money. So they've got a schedule. And every year it ends up to be about 4% of the balance that you're taking the money out. That's not taxes. That's income. And then you pay the taxes that's added to your income each year. So and I can help people understand that better if they come in, of course. Okay, so that's using your tax rules to your advantage. Let me tell you some others. For instance, if you have any kind of permanent life insurance, like whole life as an example, universal life, or if you have index universal life, those kinds of products, that money, when it comes out, is not taxable. Now, because it comes out technically as a loan. Now, it's not a loan you're ever going to pay back. Okay, you're not required to pay it back. But that is a special arrangement that the IRS has with insurance companies. Isn't that interesting? That's why whole life and those other the whole life and other permanent life insurance kinds of products are good investments, because ultimately any money coming out is tax free. It's after tax money. You put the money in from savings or whatever in the beginning, and it comes out completely tax-free. Very, very, very important for people to understand early on and continue to understand as they get older. Okay, and let's see. Let's see. Don't adjust assets properly and adjust as needed. So what does that mean? Even in our products, where they're using indexes, they're never in the market in our products, save money. But what they do is they use indexes to calculate, uses calculations for the growth in these products. But even though you're not in the market, they'll use those as reference points. And they give you a chance every year to reallocate. So they give you 10 or 12 choices and you reallocate. In tough times, you take a lot of the plain interest, which might be 1% or 1.5%, but you're still getting some gains in that, every year. But you would also, in some years, you take the S&P 500, you take various indexes, put part of it here, put part of it there, and so forth. And I help people do that all the time. Okay, how about not planning for the unexpected? In the industry, we call black swans. Remember back when we had the big housing in subprime loan crisis back in 08 and 9 and so forth. That was a black swan. Nobody thought it coming, but it suddenly was there. Okay. Well, what happens to that if your finances are affected the same way? What if all of a sudden you've got to put $30,000 in your house because you've got mold? Or what if your house is sinking and it costs like that to raise the house and preserve it? I mean, those are things you might not ever think about and may never happen to you, but you still have to plan as if they are going to happen. Now, maybe you'll never save enough money for one of those kinds of events, but if you save, some of it, the more you save, the more you set aside. I know people that are taking interest, from those kinds of monies that they set aside, but they're not touching the capital because that capital is there to preserve their safety and their way of life and so forth and so on, because they can't ever tell when those things could actually happen. Or if you're still working and one of you loses a job. I mean, I can tell you stories that, happen to people that I know and that we're working with. And, where they weren't prepared, and others that were prepared. So those things, planning for the unexpected is always something you have to think about. Setting, rainy day money aside for anything that can develop. I always say you got two funds. You got a little money, little rainy day fund that's going to take care of, my dishwasher went up, or the washing machine, or whatever. Or I had to put a bunch of money into my car because of expenses that I hadn't really planned on. So you got that little rainy day account that takes care of those things. The big rainy day account is for major problems. There, I'm using the interest. Okay, I may be living on it, or I may be setting it aside, or maybe I may be investing it. But the point is that I have prepared myself so that you have basically a smooth financial landscape. So those are some things you want to think about. And then how about not taking advantage of employer benefits? It's very interesting to me that a lot of people do not understand their employer benefits. I got a lot of government employees that don't understand their employer benefits. And incidentally, with the downsizing in the federal government, there's a lot of benefits they can take with them for a limited period of time or for a long period of time and so forth. And they may be in shock still because they found out they're losing their job, but there are severance packages, and there's also some of the benefits they can take with them. And how are they going to replace those benefits after they're gone? So I help people think about that, plan about that, to consider options and so forth. So that can be a roadblock, can it? To retiring. All these things are roadblocks if you're not prepared for them. So usually one person in a family is more interested and more adept at planning for these kinds of things. But when I'm talking to both spouses, if one is, they'll say, well, he takes care of the money or she takes care of the money or whatever. But I want everybody to have an overview of the kinds of things they have to think about, because then they can remind each other, are we doing this? Are we doing that? Okay. And then, let's see, probably, how about your estate planning? Now that's kind of a final result is the estate, but planning for it, that's a different story. How do you plan for that? How do you plan for final expenses? The last thing you want to do is not be prepared. So you have one spouse that's passing soon, and they're all of a sudden considering expenses, but they didn't prepare for them, leaving the other spouse in the lurch later. So, not a topic most people want to talk about, but I give them ideas, and I always recommend that they see an estate attorney and that they talk to their accountant each year. Let the accountant kind of update where they are in terms of their estate from a financial point of view. And then they, take that information to an estate attorney. Not something you want to be shy about, not something you want to delay. Okay? And people say, well, I can buy a will online for $100 or something. I personally don't have a lot of confidence in that sort of thing. You're not getting a human being's feedback. You're not getting a human being making recommendations, or making recommendations in gray areas where it might be 1 to 10 on a scale of that. Should we do this or not do that? I mean, you need to get some feedback from somebody with a lot of experience. That's my opinion. Just an opinion. That's this person's opinion. Okay. All right. So estate planning is a big deal. And what about trusts? Now, why would you want a trust? Interesting thing that I had to think through and talk to an attorney about recently. If you take one of our products, which are basically annuities, they protect themselves and they transfer on death. Now, if that's all true through operation of law and so forth, and they are safe, now why would you ever put them inside of a trust? Because I know people that do that. And I've looked into that, and I've recommended that to folks, okay? There's an interesting reason, okay? And the reason is because two things. What if inside that annuity you've got beneficiaries that may or may not pass away at some point during the life of the trust, and maybe you haven't prepared for that inside the trust, other than giving general instructions about the trust on the outside that could say, if beneficiaries change, here's what I want to do, okay, and so forth and so on. Because a lot of folks overlook changing beneficiaries. Second thing is, even though the annuity is safe, okay, and it's basically transfers itself to the beneficiary, so it's self accomplishing in that sense through operational law. A trust always makes everything inside of it safer. So for that element, and then it's worth considering putting almost everything in a living trust where you can still be the trustee, and you have access to all those assets, but they're protected even more if you pass. Okay, so those are some ideas about estate planning, and. Let's see. Record all assets. Yes, absolutely. You don't want to leave anything out of your estate planning. Okay, so let me think about what else I want to make sure I cover here. Comprehensive financial plan. How many people actually have a plan? Let me say this to you, that even when I've done a lot of seminars and I ask that question, how many of you have a plan? I've had more than half of the people in the room, raise their hand that they don't have, or not raise their hand and don't have a plan. Well, if you don't have a plan, for instance, in estate planning, the government has a plan for you, huh? If you die intestate, then the orphans court, where everything is probated, will decide where your assets go by law. So do you want the government to decide? Okay, you can find out what that means in terms of where your assets go. You can find that out. But I would not want the government to decide, and they can change the rules. So do I really want to have that variable in the game? No, I don't think so. And let's see. We've talked about managing your finances, using credit, and so forth. Those are all in tax laws to your advantage. And you really want to keep all those things in mind. And cash flow statements. You don't have to do a statement, but what does it mean to have positive cash flow? That means at the end of the month, you've got money left after you've paid your bills. And after, I hope, you've budgeted to contribute to those rainy day funds, that you still have cash flow, free cash flow at the end of the month. That's the way to live. Then that money's it's in your account. You get a little, a little safety money built into that account until the next month, till you get paid again, so that you don't have to worry about, and that's a good thing to think about. And so list your assets, list your liabilities. So what are liabilities? Well, you got long term, like a mortgage is a long term liability. And then you have short term liabilities, like what you're going to pay this month besides the mortgage payment. If you're paying your credit cards, if you're paying this, you're paying that. Those are short term liabilities. And so those are things you want to think about. And your asset accounts. So what is that? Everything in the bank? Absolutely. Everything you have in investments, from mutual funds to stocks to bonds to the annuities, to U.S. securities, meaning T-bills and things like that. And also, things like jewelry and so forth. If you have substantial assets like that, collectibles, whatever it is, that's some value. And you want to keep track of that, especially for your heirs. Okay? And quickly, I'll give you a few more because we're going to run out of time here. Any kind of real estate, obviously, and especially market values and equity. Equity is how much you own of the market value. So you have a house that's worth, a building or whatever it is, it's worth $300,000, and you own $200,000 because you owe $100,000. That kind of thing. Okay, so that's what assets, those kind of assets. Personal property, household items, cars. Don't overstate any of these things. Take them at the lowest possible market value. Then you'll be safe. Boats, that kind of thing. And those things depreciate very fast, cars and boats and so forth and so on. And then loans receivable. How much do you think you're really going to get back? Okay? And I have people that have lost money in loans. My advice to people is don't loan money. If it's a family and they need money and you can afford it, give it to them. And then you don't have to worry about getting it back, and you don't have to worry about having hard feelings later on. Much safer approach. And I know a lot of people feel that way. Okay, liabilities, we talked about those. Credit cards, car loans, personal loans, long-term debts, of course, the real estate mortgages, student loans, long-term, huh? Sure, sometimes very long-term. And now, of course, the universities are talking about loaning money to people that don't earn a lot of money in order for them to attend colleges and so forth. The repayment plans, I'm not sure about, and they're still formulating these plans. So those are some of the things you want to think about in our roadblocks, to actually retirement. And we're going to cover more of those things next week. We're going to talk about bad debt elimination, and that's personal cash management, different types of debt and so forth, and on and on. We're going to talk about a lot of things next week in this area. And I hope this information has been helpful to you. I really do. And again, you can call and ask questions or do anything you want. You can look at the website and get ideas. And I really recommend you do that. I want to tell you a little bit about our products. We have the best, absolutely the best products for retirement. And I've been told that by so many people through the years. They've said, I wish I had met you 5 years ago, kind of thing. There's always skeptics. I hear people say, well, I don't like annuities. I say, well, what are you talking about? And even people that are using our products will come to me and say, they told me I could get this kind of return on annuities. And it turns out it's a variable annuity. These are fixed index annuities. Variable annuities go up and down in value because in the market, I think I mentioned this before. So there's different kinds of products, but I'm telling you, these are the best products for retirement. Just like you say, and we're going to protect Social Security, no matter what anybody tells you, okay? And so you're going to have that. That's going to be there, okay? And if you have a pension, pretty safe, huh? If you got a pension, there's an organization called the Pension Guarantee Association, Pension Benefit Guarantee. So you are actually insured on pensions. So that's a big deal to know that, okay? And but if you look at our products, you can think of them as personal pensions. So if you got Social Security coming, maybe you got rental income, maybe you have our products, which gives you safe income. What you want to know is the income going to be there every month? or as close to a rental. You have to be a little careful about, do you maintain your tenants and so forth. But the more money that you've got coming that you can count on, the safer your retirement is. Imagine being in a nursing home and finding out that half your income is not going to be there for some reason. It was in mutual funds, it was in the market, whatever. The more money that is going to be coming in, the healthier you're going to maintain yourself, the safer you're going to be, the more comfortable you're going to be. We want to contribute to that. My hope is that I can help more people, and I've helped a lot of people in 25 years, get safe retirements and stay retired. If these products didn't work, I wouldn't be in business today, because this is what I do and this is what I've done all these years. You can count on this. You can count on the products, and you can count on me. I've been in it a long time. I'm honest. I work with folks. I've got a great reputation. People will tell you how much I've helped them. I get a lot of folks that would stand up for me and say, hey, he's good. He helps people. And I've had that happen a lot of the time. I get a lot of references from other clients. People come in and say, so-and-so sent me. And, and I sit down with them and assess their situation and try to help them. And I really hope that you'll take advantage of what I've got to offer you. And I hope that you'll hear me next week. But I'd really rather listen to you than listen to me. Okay? So give me a call, 410-902-0464. Mike Newmeyer. And here is what we're offering right this minute. If you're 65, and it applies to lots of ages, could be more, could be less, depending on the age, but very little difference. So at 65, I can get you 7.5% of your money that you put into these things for life and the life of your spouse. 7.5%. So if that appeals to you, give me a call. I get a lot of calls on this. All right. God bless you. Look forward to seeing you next week.